The stock market has been performing well. The economy, well, part of it's been performing okay, and the other part not okay. Today we're going to be looking at the Thackray's November newsletter. So we're going to do a video version of this. It's meant to complement or supplement the newsletter. We're going to skip over a few parts of it, and we're going to add some stuff in it as well. So sometimes it's good to read the newsletter plus look at the video as well. I'll try and keep it as short as I can. I'm going to start the newsletter by talking about what's happening in the economy, looking at the bifurcation taking place because part of the economy is doing well. And some of the lower income earners are really suffering. And this was actually mentioned in the earnings report by the CEO of McDonald's. He talked about this very phenomenon. I want to talk a little bit about what that means for the markets. We're going to talk about the technology sector. We're really going to focus on the technology sector. I really believe following the technology sector, the relative strength compared to the market is extremely important because if the sector is outperforming, that presents a totally different return profile in the overall market compared to if the technology sector starts to underperform. I'm not saying the market's going to fall apart, but the return profile really changes, and you have to start looking at other opportunities. So I want to focus on that a bit. As well, I want to take a look at the seasonality for November for the markets. I want to take a look as well at the different sectors it tends to do well this time of the year. What's coming up? We'll talk about gold, some of the cyclical sectors. We'll take a look at my rants. Got a lot of rants. Got a little carried away on those as well, but just had a little fun with that. So let's jump right in and take a look at the first page of the Thackray's November newsletter here. Here you can see I open up with a big, huge McDonald's logo, and I've got it bifurcated with one of the arms here. So this is high-income buyers, and then we've got the low-income buyers. High-income buyers are actually increasing. So McDonald's traffic, same-store sales traffic was up 3.2%. But what they're finding is the low-income buyers are just not there. And this is being predominantly throughout the economy. That's whether it's a subprime element of the economy or car leases, etc., or credit cards. It's the low income. And this sort of makes sense because of the way that the COVID money was splashed out all over the place. It was kind of crazy. And on top of that, inflation went up and it affects the lower income earners much more than the higher income earners. And on top of that, higher income earners have assets, investable assets that have been performing well, so they feel wealthier and so they're spending more. So this is a phenomenon that's been taking place. Does this mean that the stock market's about to fall apart? Well, this has been happening really since 2022. We've seen this. In fact, the Federal Reserve of San Francisco actually put out a report on this very issue back in 2022, talking about how there's really this bifurcated economy as a result of what took place by the government's actions and central bank's actions during COVID. It doesn't mean the economy is about to fall apart. You can't use this as a stock market indicator. And this can keep getting more bifurcated, and you can keep seeing different data samples coming out and saying, well, look how bad this is. As long as there's still a reasonable amount of good data indicators on the other side coming out, it doesn't bring a market down like this. It's got a lot of momentum, at least not typically. It may weaken it over time, but it's not a good timing signal, and you can become hyper-focused on some of the bad data. And say, well, the market should go down because of that. It doesn't work that way. Other things could bring the market down. There could be black swan events with a variety of different factors, but bifurcation of data itself is not usually the cause of that. Okay, so let's take a look at the technology sector here. And so what this is, this graph here shows you all of the sectors, major sectors of the market relative to the S&P 500. So the black line here going all the way across, that's the S&P 500 relative to itself. That's why it's horizontal. So when these lines are increasing, that means the sector is outperforming. And when they're going down, that means it's underperforming. So the technology sector is in gold here. And you can see that since April, we've seen the technology sector, a few wiggles along the way, but overall it's been performing well. Pull back here a little bit, but it's been outperforming. So this graph is normalized back to 1 year ago. So from 1 year ago, the sectors that are outperforming the market are technology, consumer discretionary, and utilities. The rest are underperforming. But what gets me about this graph is the pretty consistent downturn for these sectors. It's not, utilities would be the exception here. We've seen some up and down here, like a little hard to follow, gets a little crowded. But the other sectors, really, we've just seen them underperform here. So technology has been leading the market. The market breadth is very, very weak. There's a number of ways you can take a look at the market breadth, but we're not going to go into those today. We know the market breadth is not very strong. There's a few stocks driving the market, and everybody keeps saying, well, it's starting to broaden out. It has been broadening out since April, but it's still very narrow at this point. So we have to take a look at the technology sector and say, well, if it starts to underperform, then that could actually change the picture with some of these sectors. So we're going to talk about other opportunities here as well, but this is really being driven by this outperformance of the technology sector. Think of technology as, well, it's a big, huge vacuum. It's just sucking all the oxygen out of the markets. We've seen certain pockets do well, like gold, uranium, although that's pulled back a bit recently. Metals and mining has done well from the tariff issues, etc. But overall, the technology sector really has just sucked the oxygen out of the markets. Here's a picture of the technology sector just by itself here. You can see on an absolute basis, it's still in an uptrend. It hasn't broken that uptrend yet. This is relative to the S&P 500. We saw this go up. It looked like it was going to roll over and underperform for a bit, and then it once again continued higher as well. Now, down here we can see with the RSI, we can see here that it's bouncing around this 50 level. That's usually when it's in a strong secular run. You'll see it bounce off of that level. We'll have to see what happens at this point. If it does move lower and starts to move down closer to 30, that could be a little bit of a concern. Okay, so let's take a look at the small caps here, because the small cap sector is extremely important to follow as well. And if we were seeing a rotation out of the technology sector and we saw risk on mode, this is one of the areas that would probably do well. Absolute basis since April, yes, it's done well. But if you take a look compared to the S&P 500, we've seen underperformance over the last couple of years. And this is not a strong sign for small caps. Now, there may be some systemic issues with the construction of the portfolios. There's more credit risk in the Russell 2000 compared to the S&P 500, etc. But you'd still expect on a risk on mode to see this move higher, and we're just not seeing that at this time. Okay, so I want to take a look at another part of the bigger global picture here. And I think this is important because if we see the technology sector correct, and I'm not saying that's going to happen necessarily. We are in the strong seasonal period, and yes, it's still continuing higher, but you always have to take a look at other markets, trends, etc., to make sure they all mesh together. If we did see the technology sector start to correct, we could see some of the international markets actually do well. And that would be because of what we saw earlier in 2025. So in the beginning of 2025, from January to into April to the self-proclaimed Liberation Day, we saw the S&P 500 perform very poorly relative to world markets. And we saw the interest rates in the U.S. actually head up, and the U.S. dollar performed poorly. So the U.S. dollar performing poorly was really what caught people off guard. And they said in a real risk like that, we should have seen the U.S. dollar performing better. And why did that happen? Well, with the whole tariff debacle, international investors have been really invested in the U.S. market, but they said, well, we're uncertain. And we want to re-domicile at least our currency risk with the U.S., which is mainly technology. Because if you look at it, if international investors really want to get technology exposure, strong technology exposure, they have to invest in the U.S. So when the technology sector started to underperform, we saw this reallocation of currency risk. And so we saw that pull back and the U.S. dollar underperform at the same time with the technology sector. So if the technology sector starts to underperform again, that could be a sign that investors would say, foreign investors would say, well, maybe it's time to actually pull back some of our money out of that sector, like other investors, and decrease our U.S. dollar exposure as well. That would be a driver with some of the international markets. Usually when the U.S. dollar is underperforming, you can see some of the other markets, emerging markets, and some of the other markets actually on a relative basis increase their performance. So it is something to watch. But let's take a look here at this diagram here that I've got here. I've updated this as of November the 7th. This red line is 2025. This blue line is 1973. So why did I use 1973? Because this is the graph that I used in a previous publication I got. I think it was in July, saying that up until 2025, 1973 was the worst first half of the year, because that's what we are looking at, was the first half of the year, which would be right about here. And At this time, they say, well, okay, look at this. In 2025, it's still not performing well. The U.S. dollar is really down, and I think there's a lot of emotional stuff where people let their emotions rule their investment decisions. And like I said, what was happening back here with the U.S. dollar heading down was driven by the dynamics I talked about of foreign investors re-domiciling some of their currencies because of the uncertainty. What we've seen, well, let's go back to 1973. 1973, we saw here, the U.S. dollar actually did well in the second half of the year. So far, we've seen the U.S. dollar really flatten out and move a little bit higher. Nothing significant at this point. The Dixie's trading really around 99, just under 100 at this point. And we'll have to see what happens. If the technology sector continues to go up higher, once again, that would still be the magnet for foreign investors in the U.S. dollar, and vice versa, of course. But so this is also important to watch. On a seasonal basis, the US dollar tends to do well in November and poorly in December. So why it doesn't do poorly in December? There's a large amount of remittances that companies and people send out of the US to foreign countries. And that tends to take place at the end of the year. The number is actually really large. I included it in one of my previous books. It's actually mind-blowing what happens. So that's a factor. Now, in January, the U.S. dollar reverses as new orders are placed, et cetera, and tends to do very well in January. So this, and I've actually discussed this in a previous book, saying it's really a V pattern taking place. So we'll have to monitor this because there are some counter trends at this time. Okay, so let's talk emerging markets. Here's emerging markets. And on the previous page, it's just outlined here. It just says, emerging markets aren't your grandfather's emerging markets. A long time ago, emerging markets were resource stocks because just of the way of global trade, et cetera. That's no longer the case. I'm using EEM for emerging markets. There's a bunch of different ways you can look at it. But look at information technology here, dominate. This is not a resource-based emerging markets. Yes, there's resources in there, but it's not nearly as strong as it once was. So we go down and look at EEM here. We can see that it's actually done well. In 2025, it was up, consolidated, up again, and then consolidated again. If the U.S. dollar starts to move down, it can actually perform well. From a seasonal basis, these sectors, including emerging markets, I'm talking about the countries, et cetera, tend to perform well from late November into mid-April. So we're just starting the strong seasonal period for these sectors. So it's important to follow these because we might see further opportunity here. Also, too, as well, if we look at Japan here, they've got a new prime minister, and one of the first things she said was, we need more fiscal stimulus. Absolutely insane, okay? I mean, these governments today just want to keep spending money. That's their solution. Spend more money, spend more money. Japan already has a record deficit debt to GDP ratio of around 250%. So in the long term, it's going to hurt the country because obviously it's not going to pay off. It hasn't paid off in the past, and it usually doesn't for countries today. And in the short term, though, it could provide some stimulus. So we could see Japan actually do well just from the stimulus that's being enacted here. Japan, if we look at this, we're using EWJ as far as that goes. We can see here that it's actually been performing at market. It's been moving up higher here. If we go take a look at Europe, it's been underperforming. So if you take a look at this line here, and this is EZU, okay? If you take a look at this line here, we can see it outperformed the S&P 500, so this is relative performance at the beginning of the year, but look at the consistent underperformance. The European economy is in real trouble. Their governments continue to spend. They've got all sorts of special names for their programs and how they're going to invest the money, et cetera. They keep spending and giving away money, and they refuse to fix their problems, and they're in trouble. Like, for instance, Germany has been in and out of a recession. It's very difficult for Europe to do well without Germany actually doing well. And there's a number of reasons why Germany hasn't done well, but they just continue to bob in and out of a recession. Okay, so here's the UK. Same thing as the European Union. They've got the same problems from an economic standpoint. They've been mismanaged exactly the same, so they're having some real problems. I bring up these number of regions in the world saying, yes, well, look at the UK as an example. It did well right here again when the US dollar was lowering, et cetera, and they were seeing the companies and individuals redomicile their money. So what I'm saying is we could see a little bit of a bounce in some of these sectors. Long-term economically, the UK is probably not a great place to be, or Europe, the same thing. Emerging markets are a little bit different, but we could start to see some money flow into these areas if the US dollar does start to weaken. So it is something to watch out. And so the reason why I'm concentrating on the US dollar is because if the technology sector starts to roll over and starts to underperform, if that does happen, then that would be a causational factor of the US dollar underperforming. Now, a lot of people don't look at this as a factor for performance of the US dollar, but if you go back to 2001 to 2007, we saw as a technology sector was underperforming, and we saw after the tech bubble, we saw investors pull their money out of the U.S. market on a continual basis and take the money back. It actually put downward pressure on the U.S. dollar. Okay, so let's take a look at some seasonality here for November. Here's a heat map here. Here's November right here. You can see it's mostly green all the way down. I'm going to run through December here. You can see here there are a couple of red boxes here, but they tend to be small. If you want the bigger ones, we go back to the great financial crisis. So mostly green, very small. Big exceptions, great financial crisis. November tends to be a good month for the stock market on the long-term basis. Here's uranium. Look, this is such an interesting sector. Love this sector long-term. We know everything about it, I keep saying, because we know the demand, we know the supply, et cetera, et cetera, et cetera. So, but it's one of the more volatile sectors in the market. So there's a lot of hot money that comes in and goes out. And so you have to be very cognizant of that. Taking place. And I want to talk about one of the drivers of the sector that you want to take a look at if you are following uranium as well. So we saw uranium actually have this run here, 2025, consolidate, have another run, consolidate, and now it looks like it's broken down outside of that consolidation box, which is a little bit of a concern, but it really would be a much bigger concern if we saw it actually head below this level here, the previous consolidation box. That would be the big concern. So a lot of hot money came in, and a lot of hot money is leaving at this point. And the dynamics, there's nothing really that's changed except for it's just gotten better itself. But this is just the nature of the beast. And I've actually put in here, down in this panel here, which is a little bit different, because usually I compare it to the S&P 500. I put in the metals and mining. And the reason why, if you take a look here, I didn't do a correlational analysis here, but you can just see visually that it tends to have a similar, here's a consolidation time, and then up it goes, and et cetera. And we've seen the correction in metals and mining. It tends to have a very similar profile. So when metals and mining are going up and the stock market's going up, uranium tends to do well. So one of the things you want to watch out is what's happening with the metals and mining stock. Okay, so here's the metals and mining sector right here. You can see here that, look at this strong run and outperformance of the S&P 500, but we do see that breakdown that's taken place here, and we see it down here on a relative basis as well. A lot of this was driven by tariffs affecting U.S. companies, giving them a positive benefit on that. So this here could be because of could be because of what's taking place right now. What we're seeing is, and I talk about this up here, is we see the Supreme Court hearing the case of whether the tariffs are legal. So the issue is not whether the U.S. can have tariffs. They can if they're done under Congress. But the issue is the tariffs when issued under an executive order by Trump specifically. And this has gone to two courts, and he's lost twice already. Now, I say he because it has to be actually signed by the president for an executive order. And now it's in front of the Supreme Court. So what we're seeing here is, according to the betting agencies, there's a 75% chance that Trump will lose this tariff. Now, in this case. So Trump and Besson have both come along and said, we got lots of other stuff we can do. Don't worry, if we lose, it's a big case, but if we lose, there's other stuff we can do. I don't know what they can do, to be honest. Because if you take a look at who pays the tariffs, right? It's the companies that are importing the goods when the goods arrive in America. So that's going back, and I don't see how you can force people, those companies, to actually say, well, now it's going to be a voluntary donation or something like that. this is going to be a little bit of a difficult situation. The market's sort of just going, okay, we're just ignoring all this right now. And it's hard to factor in. But this could be actually a little bit of an upsetting factor. I did find it interesting that we saw here that Trump is talking about giving out a $2,000 dividend to people in the U.S. because of the tariffs that they've collected. This, I think, is just mainly because in case the Supreme Court comes along and says, you can't do that, you can't have those tariffs, then they can say, well, we are going to give you $2,000, and it's the Supreme Court that's a bad guy. We got to do something about that. So it's kind of a crazy situation right now. But on the other hand, I do talk about the metals and mining sector here. And maybe the Supreme Court actually comes back and says, hey, look, we don't agree with general tariffs and, on everything, whether it's furniture coming in from different countries or whatever it is. But on critical minerals, that, given the situation with these minerals needed for wartime, etc., yes, you can do that because this is an emergency based upon the current circumstance versus just a general tariff. So some of these companies would fall under that. So it depends on how far that would go. Would it be copper, silver? How far do you go? Uranium, as an example. So we could see a very interesting decision. Okay, so let's move on to industrials here. I talk about industrials. Industrials, yes, they've been going up a little bit. They've been underperforming on a relative basis, so nothing special. Once again, I think this has really been because the technology sector has really been sucking the air out of the markets. The U.S. economy has been quite hanging in there, doing better than most countries around the world. Materials, exactly the same, except for worse underperformance. And really, it's people don't know this, but over the last couple of years, it's really just been consolidating here. It doesn't mean they still can't do well in a strong seasonal period. So if there's any time that they're going to do well, it would be in the strong seasonal period. Agriculture, similar. Look at this, underperformance, this big, huge bounce here, and underperforms again. Still, in today's market, it's underperforming. Even in the strong seasonal period, this is not a good sign. And here's the underperformance right here. So this is just negative absolute performance. If we move on to the energy sector, important to follow. And look at this, really being consolidating over the last couple of years. Downward trend, underperforming. But I did put this box here, and that's the strong seasonal period for the energy sector from February into May. Look, the sector outperformed at that time. We have seen, it doesn't really show up here on the graph, but we have seen the energy sector actually perform well in the last couple of weeks. If we see a situation where it becomes extremely sold off, sometimes late in December can be a good opportunity, but right now it still looks like an underperformance on a trend. Gold, we have to talk about gold. Look at this, consolidation up, consolidation up, consolidation up, consolidation up, break. And then we have a consolidation, okay? So the consolidation is actually taking place a little bit lower than the peak. And we have actually seen, it's not showing up here on this graph here, we've seen a little bit of a break above that consolidation box. The concern was really, I think the biggest concern was is if it was to break really below this level here. And it doesn't look like that's going to happen at this point. We are entering a strong seasonal period for gold coming up in late December. Silver, gold miners, same thing. And we're in that pre-buy window, so we're coming into that window right now where, we're not in the seasonal period, but we can see that it start to increase. If technicals actually start to show stronger performance, it can actually make sense for an early seasonal rally here. And that's where we're at right now. So we are starting to see a little bit better performance in this coming out of this consolidation, mini consolidation. It's not definitive at this point. But we are ahead of the strong seasonal period. We have seen gold actually start a strong seasonal period sometimes, probably about half the time, early over the last few years. And maybe this is another year where we start to see it early. Here's the Canadian dollar versus US dollar. CAD is in a downtrend. That's the story. It goes up and down here, and here we are up. We're at the top of this downtrend. Until we break above it, it's still considered to be in a downtrend. And from a seasonal point of view, the U.S. dollar tends to be stronger than CAD coming into mid-December. Watch the price of energy because that could also have an influence as well. Right now, still considered to be in a downtrend. Okay, so I've talked about technology already. I've talked about small caps, consumer discretionary. Really, it's been market perform. More recently, it's actually been showing some weakness here. We see a double top here. This overall isn't looking great at this level here. So we are starting to see some weakness as far as consumer buying goes, creep up higher and higher into higher income thresholds. And we talked a little bit about the K factor. But so lower income are really having trouble spending, but it's slowly creeping up a little bit higher from what I've looked at. So we're seeing this sector actually having some trouble here. Okay, Canadian banks. Okay, so if we take a look at Canadian banks using ZEB here, wow, look at this strong performance. Look at this, outperforming the TSX index here. So why is that? Well, they've been performing decently. The Canadian economy has been hanging in. We had some mixed figures, down negative 1.6% quarter over quarter GDP. But other figures, not so bad. So it's gone back and forth. In this environment, the Canadian banks, they're different than the U.S. banks. Yes, I know some of them have operations in the U.S., but they're a different ball game. They have high dividends. They've got this oligopoly. So in a market that's a little bit uncertain, you find the Canadian banks doing well. I do want to say something here, and I have a caution actually right here, saying when the Canadian banks have had this strong run, when they come out with their earnings in the last week of November, if they are not super duper, even if they're good, very often we'll see the Canadian banks actually start to pull back their performance relative to the Canadian stock market. Rant time. Rant time. If you take a look here, rant number 1, Germany self-destructing. I've written about this before, but it just goes on and on. Germany has been doing everything possible to sink themselves economically. They're trying to deindustrialize the country. They're an absolute mess. They go in and out of a recession. They're purposely doing things to raise the cost of their electricity. I just don't get it. And I think there's a small group of elites controlling the situation in Germany that are influencing the policy in heavy ways. So here, October 25th, Germany demolished their last 2 working nuclear facilities. Yes, they demolished them. They didn't mothball them. They purposely demolished them so they couldn't be restarted. I don't know. And here's a funny thing. I actually put the link in here down below. And if you think Germany has all this solar power and wind and everything else, yeah, it has a bit of that, but it's been not very good. And they tried to actually start a big, huge hydrogen project to power the steel mills. Absolute failure. They just canned the whole thing recently. It just hasn't been working. It's just not the way to go. But they are using a lot of coal. So, and if you take a look here, I know there's a day back in February 6th, where the country is 37% powered by coal. And they're shutting the nuclear power plants down. It just doesn't make any sense. Rant number 2. This has to be the stupidest idea of 2025 that I've heard. So if you take a look here, the proposal is now that the condo prices are down, Ottawa, the Canadian government, should buy them in bulk. Okay, this is so stupid. I honestly, I just don't know. So if you take a look, first of all, you don't want governments coming in and just randomly buying stuff and saying, oh, it's cheap. Governments do not make good decisions, but they'd also affect the condo market. And I go in and outline that and basically say, look, so they come into a building, they buy some units in the building because they're cheap. What's going to happen to the prices in the same building? They're going to go down. So the ones that aren't government controlled are going to go down because who's going to want to buy units in a building that have government controlled units? They're not. The prices will have to go down. On the other hand, in the condo buildings where perhaps they're too big for the government to buy or they're too expensive, those prices would go up because they would be more desirable because there would be no government-controlled units in those buildings. This would be an absolute mess. I don't know where this idea came from, but so far, we're getting close to the end of 2025, but I'd say this has got to be one of the stupidest. Rant 3. Okay, and I brought up UK quite a bit here, and I'll probably have to back off at some point because they keep doing crazy stuff here. So they're thinking of putting a wealth tax on here, and also too, they're looking at taxing big houses as well. So this is all because of government mismanagement of the economy, and they keep doing things that giving away money, misallocating money, et cetera, et cetera. And so this is what they're doing. This is when you get a situation where the government has huge debts, is having problems, they're going to come back and they're going to find different ways to take money away from people. So more and more people are actually leaving the country. And so they're actually looking to put an exit tax on the UK. So if you want to leave the UK, there's going to be an exit tax. Big mansion tax. It just goes on. Okay, so rant 4. This is France. France is in trouble. They have a debt, gross government debt to GDP of 117%. And they've over the last decade, they've increased that by 17%. In comparison, Canada has a gross government debt to GDP at 111%. So almost as bad as France. And Canada has increased its debt 25% over the last 10 years. So Canada, so far, hasn't fallen into France's category yet. But what's happened with France is that they keep, like England, doing spending, giving away money here, giving away money there, and they start to run into problems. So what they're looking to do is they're looking to put a tax on Bitcoin, even if you don't sell it. And that also includes things like art. They're looking at art as well and other assets and saying, well, it's unproductive assets that the government can use. And so they're looking to tax it. And I put one of my posts here on this, and I go in and talk about how France is being fiscally irresponsible by spending so much money. They keep saying they're investing the money, but it just has been an absolute disaster. Rant 5. If we take a look here, this is about Uber drivers in Canada. I keep seeing this ad. I'll flip to the next page. Here we are. And it says that there's 100,000 Uber drivers in Canada. And I'm going, oh my goodness, that's a huge number. That's not a sign of a strong economy. When you have the economy actually take on a lot of Uber drivers, you have to say, well, where do they come from? So a lot of them would have taken on jobs and they may have been laid off from their full-time job, and now they're having to support their families, etc. So they're becoming Uber drivers. So the fact that we have a lot of Uber drivers, over 100,000, just blew me away. And then I talk about Canada's latest employment report that came out for October just last week, and it said that there were a creation of 67,000 jobs, higher than expected. But if you look at the numbers, 18,000 full-time jobs lost, 81,000 part-time jobs gained. So there would have been some Uber drivers in there, and there's also probably some effect from the Toronto Blue Jays being in the World Cup with some temporary hiring, etc. We'll have to see how that pans out. But when you get more and more part-time jobs showing up, that's not a good sign. Okay, so rant number 6, if you take a look here, this is about the IMF. So the IMF, I get the purpose of the IMF, but over the last couple of decades, they just keep getting more and more political, and they've become extremely political. And so my title is IMF needs to stay in their lane and get out of politics. And honestly, this is over the top. So what I'm talking about in this case is the IMF actually, the leader, the director of the IMF, what she said was, she went in and talked about Canada, and she talked about 2 things for Canada. The first one was that Canada, as far as fiscal room to spend money, has lots of room to spend money. It's one of the countries that can spend a lot, and we like the things they're spending money on. I'm going, my goodness, really? We're one of the most indebted. Canada is one of the most indebted nations in the world. If you take a look at how much gross debt they've got, and private debt is absolutely enormous. We have a lot of debt. To say that we have, and I'm using their statistics, by the way, for gross government debt to GDP ratio. That's the IMF statistics. And here they are saying, oh, Canada has a lot of room. I think this is politically motivated. And then this is actually hilarious down here. It goes on, and I talk a little bit about this. And this is, the director comes out and she says, okay, on the case of the government moving the budget from the spring to the fall, that makes a lot of sense. Really? Since when are you going to make a decision on this? And the reason is that for the construction, it makes sense to have the budget in the fall for spring construction. And I'm thinking in my head, you have no idea what goes on in Canada. Canada constructs all year, all year long. It doesn't just take off for 6 months. That's just not the way it works. And on top of that, it's a government process. This is a multi-year approval process. It's not done in a matter of 3 or 4 months. We all know that. Anyhow, so my point is to the IMF, look, just stay in your lane. Get out of politics. This is over the top. Please, just stop it. Okay, so I flip on to the next page. I've actually put in the text from the speech as well that the director gave, so you could actually look at it yourself. Rant number 7, if we take a look here, The Economist is getting it wrong big time. And The Economist used to be a great magazine. It's really slid over time. It's become very political over time, unfortunately. 2021, they said the triumph of big government. They really tried to push hey, central planning by the government is important. Big government, world government's important, et cetera, et cetera. It seems to be one of their themes. And then 2025, the coming debt emergency. What? I thought you said they did a good job. I don't understand. Now we got a debt emergency, and they're going to push big government in this again, and world government again through this. Anyhow, the magazine's just changed over time. Okay, so the last rant number 8. If we take a look at this, is actually kind of funny, a good way to finish up here. And I compare being pulled over by the police compared to this article here, okay? And if you take a look, this article says that Canada, over the next 5 years, will have a cumulative deficit of $119 billion. Now, that's US, so 164 billion Canadian. I'm going, I know that's not right. How could they be so wrong? Because I know, after reading the budget, the deficit is projected to be 78 billion the first year, and over the next 5 years, it's projected to be 321 billion. I think it's going to be much higher, by the way. So where do they get 167 billion from? Let's read a little closer. And what the article actually says is there is projected to be an extra 167 billion compared to plan. What? So you're not actually taking a look at the deficit. You're comparing it to a really incredibly high projected forecast before and saying it's only a little bit higher compared to what that other forecast was. That is crazy. And nowhere in here does this actually state that the deficit over the next 5 years is going to be 321 billion. So I compare this to being pulled over by a police officer. And let's say it's a 60 zone, you're doing 80, the police officer pulls you over and says, hey, you were doing 20 over. And you go, no, I was planning on doing 75. So I'm only 5 over. You can only give me a ticket for 5 over. What do you think the officer's going to do? He's going to give you a ticket for 20 over, period. So to compare the extra compared to the previous plan is absolute nonsense. You have to actually take a look at the deficit. Anyhow, I just thought that this was a little bit disingenuous to say. Anyhow, I hope you've enjoyed this video. If you like it, please click the like button. And also, please consider subscribing to the video to get regular notifications. Thank you very much.